All right, let's talk about something absolutely crucial for understanding any business. We're going to look past that big, flashy profit number you see in the headlines. We're going to dive into a line item that tells you the real story about a company's health, non-operating expenses. And trust me, getting this isn't just for accountants. It's how you can tell a genuinely strong business from one that's just putting on a good show.
You know when you see a headline, a company reporting some massive, record-breaking net income? How do you know if that cash came from them being great at their main business, or did they just get lucky selling an old factory? It all boils down to one critical question we should always be asking. Is this company truly profitable at its core?
So, how do you answer that? Well, the smartest analysts, they use a powerful framework. I call it the core business test. Think of it as a way to filter everything, to separate the signal, that is, the sustainable, repeatable profit from the main business, from all the financial noise that can really cloud the picture.
And the absolute key to this entire test, it really hinges on one simple concept, the non-operating expense. It's exactly what it sounds like. It's a cost that has nothing to do with the company's main day-to-day operations. Simple idea, right? But wow, the strategic implications of understanding this are just massive.
Okay, so the very first thing we have to do in our analysis is to create a clean, clear separation. We draw a hard line in the sand between two types of costs, operating and non-operating. This is the fundamental divide, and getting this split right, well, it changes everything.
So here it is, that fundamental divide. On the left, you've got the engine of the business, right? The operating expenses. This is your rent, your utilities, your salaries, the stuff you have to pay just to open the doors and run the business every day. On the right, you have everything else. This is the stuff that happens to the business, not in the business. Things like interest payments on a loan, or maybe a one-time lawsuit settlement.
Okay, so we've got the concept down. Now, let's go find the truth in the numbers. We're going to take a little journey down a simplified income statement to see exactly where this plays out and how it shapes that final profit number everybody gets so excited about.
Think of this whole thing like a waterfall. You start at the very top with all the money coming in. That's your revenue. First, you take out the direct costs of the stuff you sold. Boom, you've got gross profit. Then, and here is the absolute key move in our test, we subtract only the operating expenses. That gives us operating profit. It's only after we've isolated that pure core number that we finally account for all that other non-operating noise, and then of course taxes, to get to the famous bottom line net income.
So let's pause on that for a second, because this is the whole point. That number right there, operating profit, you'll also hear it called EBIT for earnings before interest and tax, that is the single cleanest signal you can get for how the company's core business is actually performing. It's the answer our core business test was looking for. Everything that happens below this line on the income statement, well, that introduces factors outside of that core performance.
So what is this financial noise I keep talking about? What does it actually look like when you're reading a real financial statement? Let's make this really tangible and look at some of the most common non-operating expenses you're likely to see.
You see these examples and a clear pattern starts to pop out, right? These expenses are almost always about one of two things, financing decisions or weird one-off events. Take interest payments. That's not a cost of making your product. It's the cost of how you chose to finance your company. Or a big restructuring charge. That's not reflecting how well you sold things this year. It's a signal of a massive strategic shift, maybe cleaning up old problems.
Okay, so why do we obsess over this distinction? Why does this matter so much? Because look, understanding the quality of a company's earnings is so much more important than just knowing the quantity. This isn't just some boring accounting exercise. It's a diagnostic tool for figuring out if a business is truly built to last. And this quote just says it all, doesn't it? Generating profit from core operations is critical for a company. A business can't survive in the long run by selling off buildings or getting lucky with currency trades. It has to be consistently profitable from the thing it actually does every single day. And this whole analysis we just did, it tells you if that's really happening.
So there we have it. We've separated the signal from the noise. The big takeaway is simple. Net income tells you a story, but operating income, that tells you the truth about the core business. So that leaves us with the real question. The next time you see a headline screaming about record profits, you won't just stop there. You'll know what to ask next. Not just how much, but and from where?